Duma Gqubule, the founding director of the Centre for Economic Development and Transformation, joins me now. Very good afternoon to you. Thanks so much for your time on SABC News. So most economists are suggesting an interest rate hike. What do you think, and what would that mean if we did get one?
Yes, I think what most people are expecting an interest rate hike, whether it's to 4.25% or 4.5%. And I think to be a disaster for the economy. Let's remember the context in which this is happening. We've got 12.5 million unemployed South Africans. The unemployment rate is 46.6%. The IMF and the World Bank have forecast GDP growth of 1.5% a year between 2022 and 2026. And on top of that, there are dark clouds hovering over the world economy because of the war in Ukraine. So our GDP growth forecast of about 1.7 or 1.8% will be reduced. So we should be doing anything in our power to get this economy going again. And for comparison's sake, I was just looking now, the US inflation rate is 7.9%. Their interest rates are between 0.25 and 0.5%. In the Eurozone, the inflation rate is 5.9% higher than South Africa, and their interest rates are still at zero. So our cost of capital in South Africa is crazy because central banks throughout the world have been taking restraint in terms of responding to this spike in inflation that is happening globally. There are three types of inflation that is happening globally. It's driven by oil prices, number one. It's also driven in South Africa by, the energy prices. So I believe that monetary policy, interest rates are the wrong policy to address what we call cost push inflation. Interest rates are used to control a situation where you have too much money chasing too few goods and services. We have the opposite situation in South Africa. We have got too little money chasing too many goods and services. So what we have is that there's massive spare capacity in the private sector. They can produce much more than they're actually producing because there's not enough people to buy what they want to sell. So this output gap, I believe, could be about R1 trillion in terms of the possibility for non-inflationary growth in this country. Yeah.
Duma, you're a strong advocate of the bank using more monetary policy tools to grow the economy. What other tools do you think should be used in South Africa right now?
Okay, so first of all, we've got a problem. There are no financial constraints to government spending because we have a central bank that issues the money. So there are constraints that relate to state capacity, to corruption, that relate to ESCOM and things like that, and so forth. Yeah. So, but the point I want to say is that the central bank, I don't understand why the government has to always go to Standard Bank and Old Mutual to get the money at market rates on punitive terms when we have a central bank that can provide funding to the government at no cost. What we saw during the crisis is that the Bank of England financed the entire COVID response by the United Kingdom, and the US Fed financed the majority of the response to COVID by creating money. There was no taxes that were increased. There was no borrowing that happened. All the money came from the US Fed, and the money came from the... So I want South Africans to... Why do we have to go to the bond market to get the money? Why can't we? Money is money. So why can't the Reserve Bank support the economy? I don't understand. And I haven't had a very good reason as to why the central bank can't support the economy. There's so many things that the central bank can do. It can reduce ESCOM's debt. It can finance our development finance institutions. I was looking at the IDC, and their spending during this crisis went down by 50% to 6 billion rands. Why can't they finance productive investment? I don't see how we've got this huge spare capacity in our private sector and we can finance infrastructure, productive investments. There's zero inflationary threat from demand. I don't understand it all, Zinga.
All right, so we spoke in the beginning of lockdown when those emergency rate cuts were announced, which were said to add around 0.6% each to GDP. Did we see that happening as COVID went on and as time went on? And if we get a rate hike, what are the ramifications of that for our GDP? I know you touched on it a little bit earlier on.
Yes, so the forecasts are that the rate hikes will increase by about 300 basis points over the next 2 years, and it could be more aggressive starting today in terms of the 0.5 that some people are predicting. And once you combine this with austerity from Treasury, it's a deadly cocktail that's going to reduce the growth of our economy and result in rising unemployment, poverty, and inequality. We're heading towards an election in 2024. It's just around the corner, and I don't understand a government that wants to win this election would have this death wish whereby it is implementing policies of austerity on one side and hiking interest rates that are guaranteed. The guaranteed outcome of that is rising unemployment, poverty, and inequality. I don't understand at all. So the government, we should be doing whatever it takes to get this economy growing again.
Duma Gqubule, thanks so much for your time on SABC News. Always interesting to hear his insights, especially when it comes to Monetary Policy Committee. He's the founding director at the Centre for Economic Development and Transformation, joining us there.